Hola a todos, buenas tardes.
Good afternoon, everyone, to those who are here and to those who are watching us from home. This year, we've had to do things a bit different. And of course, we have about 250 people here and an unlimited amount at home. So we were hoping to bring better news this year, and things have changed slightly, but we are going to discuss all these things. We are going to talk about the situation at Cobas, the changes that we've had in funds, in value investing, and we are going to talk about the portfolios. We're going to talk about Asia. We're going to be talking about cards, and we're going to be talking about a company called Atalaya, and we'll talk about the valuation, and then we will reach our conclusions. And then, as usual, we will have a Q&A session. I think we'll have a 1 hour long presentation approximately, and then we'll have until 8:15, or 8:30 to ask any questions you want. So let's get started. We are going to start talking about Cobas and the different points that we had last year. 12 pension plans plus 2 EPVs, 1,467 million assets under management, or under management. And of course, this year we've had the impact of the crisis on the funds and on the different economic funds. And a high percentage of holders have remained, even in the worst moments of the pandemic. We had a very resilient behavior. And the first half of the year, we see that there is a very solid holding. Our holders are patient, and they do understand what we are doing, and they are giving us their flexibility, and we need to thank them for that, because that allows us to work with freedom and render good results. And we have the same amount of holders as we did last year, 27,000. Now, what are the news at Cobas? Well, after the launch of Cobas Pensions, that has grown by 10% since last year, and it's undergoing slow evolution. And we have actually released an employment plan, which is about to come to light. And from the end of this year, any company that wishes to do so, they will be able to join the employment plan. And the way it's structured, it's very similar to Cobas Selección. And anyone who wants to offer this service to their employees, which is very important given the amount of public debt that we have in the systems, and particularly the Spanish system, it's very important to look ahead. And this is very similar to what we do in our company. Our employees will have this plan, and any company will be able to adhere to this. And at covas.com, you can expand the information on this. And the most important news at Cobas Asset Management, it's the new fee structure. We've been talking about the fact that we had the intention to reduce fees back in the day, and this was not to be made, this decision was not to be made out of nervousness or on the spur of the moment, but we really wanted to think it through. And what actually convinced me was the great loyalty that our customers have offered, the investors who are here and at their homes. You have all supported us throughout the year, and I honestly thought that we shouldn't wait any more time to decrease the fees, which was something that we had in our minds since a while ago. And we've indeed simplified the D class. Any newcomer will have 1.75, and when they reach the different time points and the different landmarks, they will end up at 1% after 7 years with us. And since we hope that most customers will remain with us, as has always been in our professional experience, and we hope that they will stay with us for many years. Our reduction from 175 to 1 year to 1 this year to 1 after 7 years, it's very very significant for our customers. And the same will apply to large corporates, and we will go from 1 to 0.75. And for pension plans, there will not be a need for certain seniority landmarks to be reached. Starting from those dates, there will be the different reductions. And by 2024, in terms of pension plans, they will only be paying a 1% fee. And by the way, this is not a measure to retain customers. As we said in our communications, anyone who wishes to do so can withdraw all their money and they will not lose their seniority, but they need to leave a certain stake. It's something symbolic, but if they tire from us, and they can withdraw all their money, and after a couple of years, they could go back and we would maintain their seniority. So I think this is quite well thought through, and it fosters loyalty. We are not the first to do this. Fidelity and some other funds have done this, and some management companies at the international level that have the same style as we do have done this, and I think this is something that is really beneficial for customers. And in order to do this, we've done some internal arrangements too, because we choose companies that are as efficient as possible, and we have acted accordingly. 4 years ago, we had a different market in mind and a different situation in mind, and there were some costs that we had to cut back, and it didn't make sense to maintain them in the current circumstances. So we have, of course, applied this fee reduction, and we have done a cost adjustment plan, and therefore Cobas is a more solid company than it used to be. And I always say that we need to come to a standstill at the personal level and at the business level, so that we can take any impacts that may come. And this has helped us become a more solid and strong company. We are developing Brainvestor. It's fully developed, and it's an app that helps improve our psychological attitude towards investing. I've always said that you don't really need to have a very high intellectual coefficient in order to invest. It's not my situation. We always do very obvious things, but what's difficult is to actually withstand a 50% decrease, as we had to bear last year, even if you're in a good situation. And of course, we need to be able to bear all this type of situations. And I'd like to talk slightly about ESG, and it's become somewhat fashionable currently, but because of our common sense, we've been doing this for many years. We do long-term investment, and if we are going to remain shareholders in those companies for 10 years, we need to invest in companies that do things right. We cannot invest in companies that cut corners constantly and that live on the edge of legality. So it's very important that we do things right. And we are therefore going to explain this in greater detail later on, because philosophically, we always need to differentiate what we do at Cobas with our funds, with, of course, legal businesses, which are completely lawful. And also, we need to consider what we need to do as shareholders in the companies that we invest in. And these are different roles, I'd say. The contract that we have with our customers is to maximize their profits, doing things right, and always abiding by the law. And our responsibility as shareholders is a bit different. We need to have our responsibility towards our conscience and towards society. And in that sense, as we have mentioned oftentimes, for us, ESG is not a word, it's a fact. 15% of our revenue is devoted to things in which we don't intend to maximize profit. But before we talk about this in detail, we'd like to mention that this management company has been the first Spanish financial company appointed Big Core, because we abide by a series of very strict codes at the environmental level and many other levels. We recycle our bottles at the office and many other more transcendent things. And we have been the first financial entity to have received this stamp, and we are also a signatory of PRI, Principles for Responsible Investment. So we are investing in companies, and we're not going to change the world by doing that. It's not our intention, but we always need to do things bearing our principles in mind. And I think we need to put our actions where our words are. And in last year, we did follow this structure, and last year we explained how we had structured SANTACOMBA, and I'm going to tackle the different points here. Open Value Foundation has released a new impact fund. We have organized online courses. We had 500 students attend one of them, the Introduction to Venture Philanthropy. We have also offered loans to different initiatives. Here we have an example, which is a refugee camp on Uganda, where they have used solar panels to power the refugee camp, which was otherwise in a very difficult situation. This was about the foundation. Then, additionally, we have the Global Social Impacts Investment. This is something that we wanted to separate from COBA so that things don't get mixed up. And I'd like to insist on the fact that, unfortunately, we cannot be devoted to this. We have a dedicated team for this. And María Ángeles Elong, my wife, is devoted to this. And for Open Value, we have María Busconde. For Global Social Impact, we have Arturo Garcia. And for Global Social Impact, we've done several actions. The management, it's been approved as a management company in July 2020. We have the African fund already, and we have released another fund in Spain with 40 million euros and with other entities. And also GSI has does meet the Article 9 of the FDR.
High demands with regards to the social character of the investments. So in general, we're talking in these funds where we usually have profitability, but we don't maximize this yield. So we have to have this profitability, creating employment and improving health in certain places where we can measure the improvements, where it's not just benefit.
Pero con otros objetivos también, ¿no? Y por último, pues se ha llegado a un importante acuerdo para nosotros con MAFRE, para el Fondo de África que ya teníamos, en el que MAFRE va a ser inversor ancla.
So MAFRE is going to be right now working with us, and we will make it grow. And the third activity that we are going to be doing with that 20% is the capital, so that the school can keep on developing itself, because Value School, you know, the origin of the school was actually books, translating books into Spanish regarding investment and social economic topics. And actually, these are very interesting books, and I think we should keep on reading most of those books. But the truth is that the work that they have done, María Ángeles, Gonzalo, and Raúl, is something that I believe is amazing, really. And on YouTube, they have 177,000 subscribers, over 7 million views, and they're doing things with Negocios TV. They have over 10,000 students in their courses. Even though we had pandemic last year, they had 9 schools were visited by Value Kids with over 400 students, almost 500 students in these courses. So I think it's very interesting. And the idea is for this to be self-sufficient. So that is why in some courses we are starting to get paid, depending on the course, with the idea of this not being dependent of us in the midterm. So it should be something that stands alone and that promotes this investment intelligence. And I wanted to say that with Value School and other entities that are now part of this, Juan de Mariana, Magallanes, we all have had a very, very good relationship with Maite Juarez, one of our colleagues, who passed away last year, after a long disease, who was working with us for 25 years, and with the colleagues that I have just mentioned as well. And we are going to launch an award, the Maite Juarez Award for Financial Education. It is an award that will have 4 awards within itself. And we want to award those initiatives that are interesting, that can be presented so that we can develop this financial education. So for those of you who are interested in participating, I think that was launched a month ago. So I think it was, the deadline was May 15th to present your application. So I really encourage you to do it, because I think that Maite deserves this. She was a wonderful person who has really helped us during these years, and we learned a lot from her. And Value School has many things that are owed to her. So this is the situation of Cobas right now in the group. Now, we're going to talk about the funds themselves, because probably that's the most relevant topic. So profitability, the yield, well, as you know, it has been quite bad last year. Fortunately, since the vaccines have been approved, we have recovered ourselves. The situation has picked up. So there has been a pickup of 66% since November, but since the beginning, we have a 20% drop internationally and 4% in Spain. But we will talk about that in greater detail now, because regardless of the mistakes that were made, that obviously we have made one mistake that we have mentioned many times, and we're not going to repeat it now. What has happened to us was that we have been fighting against the wind this last 4 years with regards to our investments. I mean, last year we were talking about this slide. Well, and we could even go back even more than that. So investing in value has always been what we have gone for, except for the last 15 years. It was consistently, that's how it worked. And it's logic. When things are cheap, usually they go to the mid prices, and those that are expensive also go down. Why? Because expensive things attract capital, and cheap things do not attract capital. So the problem with long-term profitability is that there is no capital in that business. So if a restaurant works, a Japanese restaurant works, then in a year or two, there will be 5 different Japanese restaurants close to that one. So the good profitability that restaurant had during the first year will decrease later on. And that happens in financial markets as well. So the Apple 30 companies are sending a signal to the market saying, well, we have to invest, because if I have the same business, I'm going to be paid 30 times benefit, and it's a very high multiple. But in the long term, that cannot be sustained. So purchasing companies at a low price is usually very profitable in the long term. So what we were saying last year, if we zoom in and we look at the last 10 years, which is basically the time when the growth companies have had a better result than the value companies, well, it has been more acute. Why did we have such a bad profitability in value investment in this 10 years in general? I mean, then individually, we may have done it better or worse, depending on the time. But in general, the trend is actually bad. And I think it's two reasons, or 3 reasons. The moment in time, because when something is working, it's going up. And usually it kind of feeds itself until the bubble bursts or that situation changes. The second reason that we talked about last year were the funds, the passive funds, which, well, half of the market are passive funds. And passive funds, if I'm to be honest and clear, these are funds that don't think. So investors who invest in a passive fund, they have no idea whether they're buying General Electric's, Facebook, Telefonica, or what it is that they're buying. They don't know what they're buying. They're simply buying an index. So this is an investment that doesn't spend any effort in thinking. No neurons are used for that investment. And the investments in the market do not discriminate in what they're investing. And that is actually quite interesting, because it creates a situation, a very interesting situation, it creates opportunities that are left on the table, because when half the people are investing without any logic, obviously, opportunities are created, but also we find ourselves in a situation where the market feeds itself, and it seems that that self-feeding is not going to end. So I have already said that last year. So what has happened? Well, this year we were in a situation where we were in a pandemic, and funnily enough, everything that is virtual reality has been reinforced due to the need of staying home. And obviously that has emphasized the situation even more. So that momentum for growth investment has been increased, especially with regards to values that are linked to the internet that are very important in size. So that happened until November, when, well, another reason, I'm sorry, before I forget. So the interest rates were artificially low, and we had seen them in the previous years, but now they were even greater than that. So we had the lowest rates that we had ever had. So what happens when you're investing in companies that are not making money, that are simple projects or that are dreams, such as the SPACs that we currently have? You know, these typical phenomenons in bubble in bullish bubble markets, so with low rates that are close to zero, with no forecast to go up. So companies that are going to make money in 30 years, then they could be at an expensive price, and investors will invest in them. But we invest in companies that will be paying on our investment in 6-7 years. So people don't make the difference between the ones and the others, and obviously that has been increased this year. The situation has been increased this year. But from November onwards, we started recovering the values. And the question we need to ask ourselves is this a trend change, or is it not a trend change? Well, let's see what we think about this. Well, this is a summary of what we have said. During the last 10 years, there was this momentum and spread of passive investing linked to interest rates and the digitalization of the economy. Some of it was seasonal, and others were here to last. So our opinion, this is our opinion. This obviously is very, very much a personal opinion. You can all have your own ideas about this. So we think that the momentum will change as soon as we have a turning point. Well, we will start investing in value, and the momentum will now turn to value. So passive investing will be passive, but just as it benefited growth companies, it will impact growth companies, because people will get their funds off of growth companies, and it will damage those companies instead of ours, because we are not usually in those funds. So it can be positive. So the interest rates, we think that that is going to change, and it's going to favor us as well. That's why we think it's green. Why? Well, because I was reading today that the expectations, investment forecasts are at 2.4%, the highest level in the last 10 to 12 years. And obviously, there will be an inflation. So if they are giving $1,500 to every American citizen, what they could not do in 2009, 2010, 2011, because they did it through the banks, and the banks maintained that money in their reserves without lending that money. Now they have done it by doing it directly with citizens. The money is going to go straight to people's pockets. So this is like giving money to people from helicopters, you know, like having money rain from helicopters. That is inflation. So when will it be reflected in prices? Well, we're seeing it right now. We're actually seeing it in the prices of every product, not travels, but the rest of the rest of products are more expensive. And digitalization, well, some things will be maintained, other won't. We will play less with video games in the next months than we did in the previous months. So some things will change and others won't. I think in general, and I tend to think answering some of the questions that they will ask me. The type of life we had 1.5 years ago is the sort of life that we will do in a year time. If we did it, it was because we liked it and it was interesting to us. And in a year, 1.5 years time, we will do the same thing. Instead of going 5 days a week to the office, we will only go 4. Well, maybe. Those are reasonably marginal changes. So this is my opinion. Now, as for the facts, value with regards to growth. So the sales associates are some fund managers in New York who have been comparing value versus growth, and they did an analysis that is available for anyone who wishes to look at it. That was very interesting. They were saying this horrible value cycle, is it different to others? Has something happened that makes us think that the solution will be different to other cycles, that it will revert and then grow? And their answer was that they haven't found any different factor to the previous ones. So the most important maybe would be technology. Well, maybe now companies, they have more intangible assets such as Facebook, Google, and so on, when there were more machines. So they have actually bet on that. But even if we think about technology or intangibles, I think that the value investment is always better than growth because of what I was saying previously, because it's logic. It's logical. You always, in the long term, the cheap goes to mid-price and the expensive goes to mid-price as well. So in this 1100 percentile, let me see if I can go backwards and show you that. So this drop here, this drop in 10 years, that means that never has there been a worse period in the history of the markets, a worse value behavior. It's the worst value behavior in the history that has been measured. So what could happen if we go from a 100 to a 95 percentile, or to the average here? If we go to 95, all the way to 95, that means that only 5% of the previous periods have been better than the current one. That's a very bad period. That means 37% better value performance. But if we go to the average, if we go back to the average, so value goes up to the normal average we have had in history, that would be a 76% return with regards to growth. And it's interesting because if I ask someone, what was the best value behavior from the year 2000 and the year 2003, so 2001, 2002, 2003. So the last time we saw something similar was in 98, 99, 2000, when there was an immense growth of technological companies. Well, funnily enough, the excessive return was 80%. And that is actually the return that we had in both our international and Spanish fund. The stock in the year 2000, 2001, 2002 fell 40%, and we grew 40%. So that's 80% going back to the average. And then, as always, things go beyond the average. And they go to 60, 70, or 30% percentile upwards. And that is why we saw that wonderful return on value until 2018. So this is what they say that will happen if we go back to the mean, the average. This is a theoretical discussion. Obviously, it could happen or could not, or maybe it won't. So we have seen that the MSCI growth was 23%. So relative return, they're starting to see the first returns, and in this case, fortunately, we were lagging behind during summer, and we have had 52% during that first period. So fortunately, we had good results, and actually it was overdue. Now, this is just a theoretical discussion about what happened in these months. But what happened in other value periods? Well, it's what we are saying here in the second sentence. The longer it takes, the more abrupt and lasting the rotation will be. It's logical. The more it takes to go up, the the greater that climb is. That always happens. So during this last 50 years, and we have gotten this from Richard Fenna, who's another in value investors from Sanford and Bernstein. They have really worked on their numbers. They've crunched them, and the average was that in this period, the value has done it better than growth. Value has done it better than growth, and as you can see, it happens over a 62-month period, so 3, 4, 5 years of the value performance. Because what we were saying previously, when something takes momentum, it lasts quite a long time. So we see that it's 200% return on value. So you see here these figures, 213, 75, and 138. That's what happened previously, but we don't know what will happen. Obviously, when you have a fund to 6, 7, 8 times profit, that's what will happen to us with those funds as it happened in previous times. So that is the comparison between value and growth. But the thing is that, funnily enough, we invest on value because we purchase companies at PER 7, 8, under 10 always, but we're not avoiding growth values. Are our businesses boring? Do they not grow? Are they just the last part of a cigarette that people throw on the ground and then we just pick it up and try and get a couple puffs out of it? Well, let's look at our international portfolio right now. As we usually say, we buy growth, but not at any price. So this is the company that we have, Golar. This is the EBITDA they had in 2016, 2017, when they only had projects. And currently, they're having 250 million EBITDA right now. And their forecast with the contracts they currently have is 400 million. That's the green line in 2024. And the gray line are options that could be more or less true, and it could take them to 800 million EBITDA. So if this isn't growth, then please, could someone explain to me what this is? Because this is an absolute growth with a market niche, or actually 2 market niches. And the most interesting one where we could have an important option would be the leaders in the world, really the only ones who have created a specific solution for gas to be liquefied in a floating platform in a ship. So that's why they're special, and they have such a clear growth. And if we go to our second biggest investment, we see here that it's mature, and their main asset is COS, which is homes for the elderly and intensive care for patients who have had some acute disease. So we were investing 15 years ago into it. This was the beginning of their business. It was 10 million EBITDA in 2006. We didn't even talk to the company about this business because it was so small. It didn't really make any difference. Before the crisis, they had 100 million EBITDA, and when they recovered, because obviously there has been a drop due to the fact that sadly many of the elderly passed away, and they had to face restrictions because people couldn't go to their homes. But this is a business that will grow, that will keep on growing. They will continue in this trajectory, I would say forever, but we can clearly see their trajectory, and it will multiply by 10. It has multiplied by 10. It's EBITDA with not much investment and with not much debt. They haven't really been in debt due to that. And this is the second example. And the third example is Dixon's car phone with a 6.5 in their portfolio, just in the electrics. It's true that for phones, they have decided to leave that business, but the electricity, which is the main business we're investing in, it's 6,500 million pounds, so 6.5 billion pounds, and now it's 8.5 billion pounds. So it's mainly in England. They have grown, but mainly because they are the leaders in amongst the Nordic countries. It's spectacular, their position. So if this isn't growth, please, could someone explain to me what growth is? Because some companies called growth companies haven't really gotten this kind of growth. And some people will say, why don't you invest in technological companies? Well, in the last fiscal year, Dixon's Carphone, out of those 8.5 billion, are online sales. They're the leaders of online sales in England, in Denmark, in Sweden, in Norway, and in Finland, and in Greece, obviously. So 8.5 billion pounds sales online, making money, obviously. So this is a company that has actually beat Amazon in its market. But the thing is, we don't like to pay 40 times benefit. So this would rather be in Dixon's car phone, obviously. So you must forget about the fact that investing in values is investing in companies that are boring, that don't grow. No, time is always running in our favor. And every year they are worth 6 or 7% more, no doubt about it. So let's review our portfolio. This is our potential. It's quite similar to last year's, and we haven't had much of an impact. The pandemic hasn't really impacted us because we didn't have any companies that had to do with events or travels. We didn't have much impact. It's true that in companies such as Arita, for instance, and others, we did see that there was a drop in restaurants and cafeterias and coffee shops and so on, obviously. But those were minor things and an impact that only lasted 1 year. They didn't need capital to save them, and we were lucky because you could have a company dedicated to events that's wonderful, that works very well, but that had to cancel all of its work during that year. So we were lucky. We were lucky that the objective price has been maintained, so the fund is now worth twice as much. Now, the return on capital is still very high. It's 28%. It would be 38% because we have raw materials. It represents 25%. It's quite high, but we considered that last year oil as well as other segments of the raw materials market were very attractive, so we increased our position there. And that also has protected us a bit. I mean, it's not excessively better, but it could protect us if there is an inflation. So it's always good to have some raw materials to defend ourselves in the case that there is inflation. So that also defends us. And the profile is still more or less the same, although we have had a recovery of 6.8. Our benchmark is 16.5, and Standard & Poor forward 12 months. That's how we look. Our the next month is 22 times benefit. So we were at a third of the U.S. price. So we have a great safety margin. We could grow 50% and be our fund and the index at the same price. And if you ask for my opinion, I think that the same thing will happen. So our free cash flow yield is 20% because many of our companies do have cash flow. And there are lots of family companies, lots of control. Many people are putting their money in the companies as we are doing, really. I'm going to go fast about this because these are companies that are very similar to last year. We haven't really changed the main values. So if you have any doubts with regards to any of these companies, please just let me know and we will talk about them. So in Spain, we have the same situation. If in Spain there was an impact in the objective value, but in Spain, we haven't really seen any impact, and the objective value is actually at record levels. And that means that actually has allowed us to grow twice what we expected from our point of view. Our OCE is actually very good, 29%. Our PER was 7.5, and our group of control is 82%, which is actually very good. So now, as for the blocks, they're quite similar. We have improved our position in Atalaya. Juan will talk about that. We've also improved our situation to FX and in Miguel y Costa, some companies that have actually suffered this year. And to be honest, here in the Spanish fund, we have done it more than the international fund, because in the international fund, what should have happened would be for certain important values such as TGP, TK, that has had an extraordinary year, although their shares went down 50%. Well, they went from a $1 per share dividend last year. The previous one, they had a 0.75, 0.76. In 2020, it was 1, and now this year it was even more because they have long-term contracts. But the shares went down 50%, and it's now 8 euros. And at a certain point, we had shares for 8 euros, and they would give us a payout of $1. So that is completely sustainable. It was wonderful. So TCP should not have fallen, and we should have been able to purchase that and buy something else that should have fallen because they were really in a bad situation. But we couldn't do it because everything was falling, and it was a ridiculous situation. But, well, that's a situation we were dealt with. So here we have been able to do more things. We have been able to purchase companies that have suffered quite a bit. Their shares value dropped quite a bit. So there were two small companies that suffered a lot, and we had to sell them at a loss, although they weren't very important, such as Alaris, for instance. But here in Spain, we didn't have to do it. We didn't have similar situations to that. Now, let's talk about 3 investment cases. We are going to give the floor to our Shanghai partner so that he may talk for 8 minutes and tell us why we're investing there, what we're getting from that. Right now, the portfolio is 7% of our international fund, but it's 15% of the big companies. And we will always go where the value is. That is why we have someone there. And we have been working with Min Kung for 12, 13 years, and we are completely in harmony with him. Now, after Juan Huerta will talk about the case that we mentioned a few years ago, the automobiles, comparing maliciously Tesla and Porsche. And then Juan Cantus will talk about Atalaya, a very interesting company that we have in all of our funds.
Or hello everyone, this is Mingkun, Cobas analyst in Asia. I'm speaking from Shanghai, China today, and I hope everyone is doing well in Madrid. It's a pity that I cannot attend the conference physically for obvious reasons. Pandemic still constrains somehow our travel around the world. However, as we can see from news every day, we now have vaccines. Actually, many different types of them. So things are looking up, and hopefully we will be able to travel again very soon. Today, I want to talk about Asia. Try to give you an update on our investment in Asia with an overview as well as a case study. Our Asia investment block has performed well in 2020. It generates double-digit return by itself during the year. Meanwhile, it contributes positively to our international portfolio since Cobas' inception. As of March 30th, there are 8 Asian companies in the international portfolio. It's a group of companies with decent business, average ROCE of 39%, and safe balance sheet, 7 of them in net cash position. Meanwhile, they are trading at attractive valuation, 4 times PER, and finally, all of them are with family behind. I think it will be fair to say our exposure to Asia broaden our investment pool geographically and add value to our customers. So, these are our top 5 in Asia. Number 1, Samsung C&T. It is the holding company of Samsung Group. The most important asset of C&T is Samsung Electronics, which accounts for 75% of sum of the part value of C&T. We are investing in C&T because of the intriguing share price movement between Samsung Electronics and Samsung C&T. Basically, electronics has been going up while C&T has been flat. So simply put, the holding company discount has been widening from 30% historically to a 60% during the last few years. Number 2, Daiwa Industry. It is a Japanese company operating in a commercial kitchenware business. It's trading at 1 time PER, high ROCE business with barrier to entry. But obviously, the pandemic is not good when people are not going out to restaurant as often. But it's also obvious that it is not a normal situation, and we think people are likely going back to their dining habits post-COVID-19. Number 3, Hyundai Motor. It is a Korean auto company This is not a new one for everybody, I believe. Pacific Group. It is a Korean cosmetic company with long history and strong brand. They are revitalizing their brand and adapting to the online channel, so we expect things will be better. And the last one, LG Electronics. We used to own 1% of LG Electronics in a portfolio, but we have taken some profit as the share price went up. Now we will have a deep dive into it. LG Electronics is one of our typical investment case. Let me give you a summary in the first place. First, LG is a global leading company in home appliances and OLED TV business. Those are cash cow business, generating stable cash with strong brand and technology behind. Second, it has a dog business, that is the mobile business, which we consider not competitive after studying Samsung Electronics for years. The mobile business has lost big money in the last few years, and market doesn't like it. Third, it has a family behind to drive changes. And lastly, we can buy the shares at significant discount. Now, let's go to more details. In fact, we have been following LG for years in order to benchmark our investment in Samsung, which also present in mobile and appliances businesses. As you can see here, this EBIT chart, the gray one, home appliances, and the light green one, home entertainment, the OLED TV, are two pillars of profit. Meanwhile, the dark green one, the mobile business, made 4.8 trillion EBIT loss in the last 6 years. Also below that break-even line, there's a black one, which is the vehicle component business. This is an interesting one. Although the vehicle component business made losses because it's still at investment stage, it supplies a significant part of value to GM's Bolt EV. That fact speaks for LG's capability and bring a potential of high growth when electronic vehicle takes off. LG Electronics is covered by technology analysts. It has long been valued at a discount to its peers for its infamous loss in mobile business. However, it is obvious that Mr. Market had overemphasized the dog while undervalued the cash cows. After all, home appliances with very small growth is too boring for tech investors. However, that brings us an opportunity to buy good business at discount. In addition, preferred shares trades at some 50% discount to common shares. We certainly welcome this extra layer of margin of safety. Next slide. Let's see what happened. This is a chart explaining how many shares we owned and the share price of LG Electronics. So we started investing in LG in May 2018. Later, a catalyst came in when the current chairman inherited the empire from his father's sudden death. He started reviewing LG's wide business portfolio with an aim to focus on core business while divesting the non-core business. As more evidence supporting this positive change, we bought more shares along the way. As a matter of fact, LG Electronics announced to set up a JV with Magna for EV component business December last year. And just a few weeks ago, it decided to close the mobile business altogether. When I look at this chart, there are three key takeaways for me to share with you. First, it is impossible to time the market. As you can see, the share price have been flat for a long while, but jump up 2 times in a matter of few trading days. And second, patience pays when we buy good business at discount. Like in this case, we are confident on the cash cows business, so we are happy to wait. And lastly, family stewardship, most of the time, helps to unlock value. Alright, to conclude my speech, I think our exposure to Asia help expand our investment pool geographically, so we have more opportunity to find value ideas that fit our style. In addition, we have adopted in Asia the same approach we had in Europe since the very beginning. We look to buy good business at reasonable price, company with solid balance sheet, and family stewardship. This approach has worked for decades. I think it makes sense to stick to the approach and invest for the long term. That concludes my sharing, and I do hope this will help you to get an update on our Asian investments. Again, I wish everybody is healthy, and I look forward to meeting you all face to face in the near future. 再见 or adios.
Buenas tardes.
Good afternoon. Approximately 2.5 years ago, during the annual investor conference in February 2019, we devoted some time to analyzing our investment thesis for the automotive industry. Today, we are going to recap, see how that thesis has evolved, and where do we stand. This slide is exactly the same that we showed during that conference on 2019. Here we show the evolution of the share price of these companies in the last few years until December 2018. We were invested in Renault, Volkswagen, Porsche, Hyundai, and BMW. And what's important here is that those companies were listed at 5-year minimums at that point in time. That was the reason why we invested them. Why were they at 5-year minimums? Well, first, because the market was discounting a decrease in the economic cycle. Secondly, because of the disruptive waves that were structurally challenging the traditional manufacturers, original vehicle manufacturers, and the autonomous vehicles, electric vehicles, potential CO2 sanctions. Well, and this resulted into what we considered back then to be a short-term market inefficiency, because these companies, precisely because of their price, they were an implicit negative value. That's to say, considering the net cash that they had in their balance sheet and the industrial stakes that they held, they were listed at an implicit value that was negative or close to zero. And back then, we regarded them as hidden assets. What is it that has happened since then? Well, here we show the evolution of the share price for these 4 companies, the 3 main companies in which we were invested, and BMW, where we had a marginal position slightly above 1%. Here, as we see, Porsche performed quite well with a revaluation of 76%. Hyundai and BMW performed reasonably well, and Renault didn't perform well. It's important to highlight that these companies are good dividend payers. They have been paying out dividends during the last 2 fiscal years. So if we were to take into account profitability based on the yield, we would be talking about a revaluation of 85% for Porsche, 40% for Hyundai, 20% for BMW, and slightly less negative, minus 30% for Renault. At any rate, the yields, the profitability weren't exceptional all in all. It's also important to recognize that the yields or the performance of automotive industries or of the automotive companies has been better than the international portfolio overall. That's why we have reduced the weight from 11% that we had in 2018 until 5%, which is the weight that we have today. That's part of our investment process, reducing the weight of companies that have a reevaluation potential that decreases as the share price increases and replace them with companies that have more revaluation potential. And this is precisely what we've done in the automotive industry. I don't want to miss out the opportunity to explain what has happened to Renault specifically. Many of you may be wondering what has happened to this company. Why did it perform so badly? Is this an investment mistake? Well, after thoroughly analyzing this, we have concluded in Cobas that this is not a faulty investment strategy. Initially, we thought that their security margin was very large because it was very inexpensive, and this still applies. They have 40% stakes in Nissan, which is a Japanese car manufacturer, and they're listed too. These stakes are worth 8 billion euros market price. And in addition, Renault, quite recently, in the last month, has sold their stakes at Daimler, the matrix of Mercedes, for approximately 1 billion. So these two stakes amount to 9 billion euros. And this is practically the capitalization of Renault in the market. And this goes to show that the market, so to speak, is giving us for free the automotive industry and the to the financial industry. At the same time, Renault and Nissan have followed their own process, and this was one of the main reasons why we invested in Renault. And this operational circumstance in the two companies has evolved positively. They very recently published a new strategic plan, and we have analyzed it, and we consider it adequate. But we must recognize that the performance has been bad, and we think that we are going to need more patience than we initially estimated for Renault. I am now going to use the following slides to talk about our investment thesis for Volkswagen, for Porsche. For those of you who don't know it, I'd like to explain that we are invested in Volkswagen through the matrix Porsche. 100% of Porsche's value depends on Volkswagen. Back in the day, we already explained what we thought had to happen at Volkswagen to close the valuation gap between the listed price and our estimated value. With this slide, we are going to explain that some of these elements have already materialized and that our opinion justifies that revaluation that the stock price has undergone. Here we have, firstly, the success of their electric vehicle strategy. Approximately 3 years ago, they presented a new strategic plan focusing especially on becoming the #1 for electric vehicles. And actually, currently, Volkswagen is the first company in the automotive industry being the most aggressive in the release of electric vehicles. Actually, they're planning to release 70 new models from here until 2030, which cannot even compare to Tesla, which Tesla cannot even compare to. This is an aspect that is already materialized. Also, they are meeting the targets for emissions for 2020 and 2021. This relates to the first point. There was a lot of uncertainty in the market on whether the automotive industries or the automotive companies or Volkswagen in particular were going to be able to sell sufficient electric vehicles to avoid massive sanctions. Well, currently they haven't paid any sanctions whatsoever. Well, practically they have reached their objective and they have paid practically nothing. In the year 2021, because of the reasons that we are explaining, because of the strategic plan with regards to electric vehicles and where they're headed to, we think that they're not going to have any problems in meeting the emissions targets established by regulators. So we considered that they are compliant, and therefore we have cleared this thesis for our investment too. And here we have the following point, which is the improvement of efficiency and margins. Volkswagen has published a new structural cost reduction plan and efficiency improvement and margin improvement. The CFO and the CEO are working jointly, and even though some of the trade unions are a bit reluctant, they are moving in the right direction, and we consider that they should be able to meet their targets in the midterm. With regards to the last few points, asset sales and simplifying the company structure and recovering the demand, this haven't materialized yet. They started out well at Volkswagen with reducing their structure with the spin-off with MAN and Scania for trucks, and this was already underway, but they have come to a standby because of their reluctancies and the internal battles that are being triggered by the trade unions and the low Saxon government, which is one of the stakeholders of the company. And as we know, this has delayed the recovery in demand. Nonetheless, we already see some signs as to the fact that the main markets where Volkswagen is present, China, the United States, and slowly are in Europe. But nonetheless, we still see that demand is picking up. So when the situation normalizes, where more people are vaccinated, and when the situation becomes a bit more standard, then the demand for cars will pick up, and the automotive industry will recover slightly. This is one of the slides that Paco was referring to. We consider that there's still great irrationality or inefficiency, however you want to call it, in the market. And we see that the market is actually favoring is exaggerated in the way they're favoring some most famous electric vehicle companies such as Tesla. But there's another one, like, for instance, NIO, a Chinese company. Their capitalization is 60 million euros, and they sell 30,000 cars a year. And Volkswagen is selling 10 million cars a year. And at the same time, the market is going against good old manufacturers, so to speak. And this is an inefficiency the way we see it. In order to relay this, I'm going to use a table and a graph. This table explains quite well what is going on. We see that in 2020, Tesla doubled the amount of cars sold by Volkswagen. Nonetheless, they're still the second line. But this year, the market consensus estimates that Tesla and Volkswagen will be on par in terms of the amount of cars sold, both with a similar market share, which is 1/3 of the global electric vehicle market. What does this mean? Well, we think that Tesla is listed at 7 times the price of Volkswagen, and this shouldn't be because of the amount of cars sold, because both companies would be leveled by year end. And we also need to remember about the cash flow. In our valuation models, we have considered that Volkswagen will generate about 11 million euros this year in terms of cash flow. But the market considers that Tesla is going to generate $3 billion. But it's very important to highlight one piece of information here. In the first quarter of this year, Tesla has generated $300 million for cash flow, but this includes 500 million in terms of credit lost based on sending electric vehicles to other manufacturers who were not succeeding in selling enough electric vehicles. And another very important part of that is from selling bitcoins. So there's 300 million that really don't pertain to their core business, which is selling electric vehicles. So that leads us to think that Tesla is not currently making money with the sale of those electric vehicles, which is their core business. Additionally, the market cap of Tesla is 7 billion, 700 billion, which is above 7 times above that of Porsche or BMW. Some argue, and they say, well, really, Tesla does deserve this better market valuation from the market because their technological position is stronger than that of Volkswagen. But we do not completely agree with this argument. There's 2 elements that say that Tesla has an advantage. First, the electric vehicle and also the autonomous vehicle software. With regards to the electric battery, there's many data, many reports that show that the efficiency of the battery or the cost of the battery is really not that advantageous. This means that in terms of battery technology, Tesla and Porsche are on par. So we cannot agree on that. But it's true that for software, for autonomous vehicles, Tesla is ahead of Volkswagen and the rest of traditional automotive industries, or companies rather. But what is it that's happening here? Well, this is the investment level, the amount of investment that they place on R&D every year. Volkswagen invests 17 billion, and Tesla doesn't even get to 1.5. 1,500 billion or 1.5 billion. So we see also in this additional chart that between 2016 and 2018, Tesla invested much more on per car that they produced, and now they are on par. So this goes to show that sooner than later, this technological advantage on software and on autonomous vehicles that Tesla has over Volkswagen will actually be reduced, and it's actually not enough to justify that their capitalization is 7 times that of Volkswagen. And in order to conclude, I'd also like to say that we still think that there is a great investment opportunity in the automotive industry, and that's the reason why in our international portfolio the weight is still 5%. There is irrationality in the market, as I tried to explain, and our investment theses are halfway materialized, especially in the case of Renault, but we still think that there is an interesting revaluation potential, which is very compelling. And this was all from me. Now I'll give the floor to my colleague Juan Cantus, who will talk to us about the investment thesis for Atalaya Mining. Thank you. Thank you very much, Juan. Good afternoon or good evening. In the next few minutes, we're going to be discussing Atalaya Mining. Atalaya Mining is a company present across all of our portfolios, and it's one of the main positions held by Cobas Iberia. Particularly, we're going to be talking about Rio Tinto, which is where most of the value is to be found. Firstly, on this slide, basically what we want to show is why we are very comfortable investing in this company. First, we are talking about a copper mine. And that, as such, is very reassuring. The raw material, this copper is very easy to estimate demand for it. So if you analyze the offer well, it's relatively easy to ascertain which projects are going to come in, which ones are about to finalize, and it's very difficult to get it wrong. And if, in addition to that, you join at a very good price, and you benefit from a revaluation, and now it's listed, and the share price is reaching the maximums, and it's relatively inexpensive. It doesn't have any debt, and it's close to home, and that's very convenient because we hear news directly, and we miss out. We don't miss out on that many things. We find out earlier than others. And also, it's very important to note that Rio Tinto has the support of the main political parties in the region of Andalusia. And most importantly, it's led by a CEO who has managed to meet all production targets in terms of time and cost since mining was restarted in 2016. We also bear in mind that during all this time, he's also had 2 production extensions or increases. It just goes to show that they're really on the right track. This would have been a typically value type of investment because you invest paying less than you paying at a lower price compared to what you get. But they have additionally included a technology called e-legs. They have been working on this technology since 2015, silently from Rio Tinto. We didn't find out about this until November. And in November, this was released. This was made public. E-legs is a technology that allows for the better final or end product to be obtained at the mine as such. Typically, at the mine, they offer copper concentrate, which is an intermediate product. This copper concentrate approximately has a volume which is 5 times the end product. Well, that 5 times the product needs to be transferred to the harbor of Huelva, the port of Huelva, and then it's taken to China where they do the smelting. Well, this technology allows to obtain the copper cathode at the mine itself. But there's an additional advantage because they're also producing this end product. We also obtain value from other metals, which are also extracted when you extract copper. But we were not receiving the proceeds from that until now. With this technology, nonetheless, we are going to benefit from this extraction. Possibly the most important metal in this context would be zinc. And this has the advantage of being a green product, which requires a low investment because opposite to other alternative technologies that aspire to solve this very same problem, this doesn't need high temperatures, high pressures, or abrasive acids. Therefore, if this technology is successful, as has been in the lab and in the pilot project, we hope that this will increase the value of the mine, and we will get some margins that intermediaries are getting. Were getting until now, and this means that the negative impact that if there was a negative impact, this wouldn't have so much of an impact on the mine, on the life of the mine. And right now, in Rio Tinto, there are some areas that we don't want to exploit just to get copper. But if in addition we can get zinc or silver, gold, then it'll be justified to exploit those areas, and therefore the life of the mine will be expanded. So it's very interesting to perform some investments in explorations right now, and also to harness the advantages of this very same technology to have collaboration agreements with other mines which are working in the nearby areas, also considering some M&As potentially. On this slide, we want to portray the main scenarios, and our conclusion is that we don't really need to have too aggressive hypotheses to justify the investment in Atalaya. We are taking as reference a copper price which is very low compared to the price that we are getting right now, or we're not introducing in our hypothesis an increase in demand because of an increase in sun power or wind power or sun power, which is actually something that requires more copper than alternative technologies. Or we aren't factoring in the increase in production of electric cars, which consume 4 times more copper than a combustion engine. So this would increase demand subsequently and the price accordingly. And actually, it would take a few years to actually level up. And in order to justify this investment, we're not even factoring in the new helix technology that we have just explained. Therefore, and to conclude, we can state that we've had this company for a couple of years. We increased our position in November. They offered us to increase our position, and so we did. And what we did back in November was to actually flip a coin, and that coin will probably fall in a couple of years, and we will see whether we have won or if we've won a lot. And this is the scenario that we foresee for the next few years. Thank you. With the presentations of Juan Huerta, Juan Cantus, and Mikum, we have analyzed a very significant amount of the international portfolio and 25% of our large corporate portfolio. This is something that we do every year. We break down our portfolio to you, we explain our reasoning and our rationale behind our investments. So it's obvious that the fund is 7 times underrated, and in order to get 15 times the profit, we need to see how to close the gap, and this is something that we discuss very frequently. But we are perhaps repeating some of the points that we mentioned last year, but there are slight variations. The market is efficient and will always prove us right in the long run. We hold no doubt as to that fact. We have had some headwinds in the past, but now we are sure that there will be some tailwinds, and there's a lot of buybacks. We see that owners are indeed seeing the benefits in this, and that is actually a very significant tailwind. And things are happening at the companies. There's all sorts of restructuring processes. We have Aditza here, and we haven't discussed it yet, but as you very well know, it's a company where we've done an exercise to try and support the change, to seek an improvement. And we think that the direction that the companies followed is much better than in the past. And of course, we sometimes we need to roll up our sleeves and do things different to what we normally do, and that was necessary, and we've done that. And for some other companies, the situation is very different, and it's not necessary to force anything. Of course, low prices are bringing about financial operations, takeover bids, etc. Some have better prices than others, but we will consider, of course, all takeover bids. The ones that are interesting will be accepted, and those which are not won't be. When someone asks, when do you sell? Well, we sell when we find something better. Even a regular takeover bid in terms of price could be a good option if we can buy things which are even at a better price. We are not talking about the fact that a non-optimal price for a takeover bid is bad news. It's opportunities that we need to assess accordingly. And the gap will close actually in many different ways. And obviously, the greatest change and the greatest tailwind that we could have is that the market, as we said in the beginning, needs to be efficient. It always is, and there's no reason to think that it won't be this time. We hope that on November 1st there will be a point for change, and we hope that the good management of value will continue for many years. Here we have what we think should happen to close the valuation gap in those companies. There's a common denominator. There's simplifications, change in structures and movements. Owners are not happy with the market price, with what's happening, and they're taking action, doing things in general. And some others are really not doing, there's nothing wrong going on, but it's quite likely that things happen. Some have new businesses. Maire is a company that we haven't really discussed at length, but they're very interesting in terms of the projects for energy transition. They have a hydrogen-based technology, and this will become visible in the future. And there could be some other takeover bids. We don't know where they will be coming from, but I'm sure they will be. So these are many options to close the valuation gap, and I'm going to reach my conclusions now. And here, once again, we considered one more year that there's very high potential and there's an additional advantage this year. We've seen our companies under great distress, going through a global economic crisis, a decrease in GDP from 5 to 10% at the global level, and they have practically all of them have been able to withstand the impact, and some companies that had some financial issues have actually been able to solve them. And we are currently at a situation where they have no other option but to continue to generate cash. And of course, this will end up being reflected on their valuation. And as we said, we hope that there will be a change towards value investment. Possibly the trigger will be the increase in inflation and the increase in rates, and this will possibly cause the discount to be higher than what's being used right now, because actually some companies are really not using the discount. It doesn't really make a difference if you make money now than in 50 years' time. But all companies are growing, and the key is where they will be in 10 years. Gas will be there, energy efficiency will be there. Gas is the healthier fossil fuel, and in the next 30 years it will be part of the generation base. Also, electronic appliance consumption will remain and will continue to grow. So we are in growing businesses that grow a bit every single day, and we aren't not willing to pay 40 times profit or 22 times profit, which is what Standard & Poor's is making right now. So anyway, with this cash generation, slowly but surely the gap will be closed and we'll see the value. Value will be recognized. The last 6 months have been the best, together with 6 months that we had in 2019. Since March to September in 2019, there was a 60-something, north of 60-something increase in revaluation, and this is something that we've also seen in the past few months. And if someone asks me why we grew by 50% last year, well, I don't know. Yeah, it's absurd that some companies that are increasing their result all of a sudden decrease by 50%. It's very difficult to understand, and it's equally impossible to understand that there is an escalation in profit by 65%. And of course, what is self-evident is that we will be closer to 190 than to 80 in not that much time. So we really think that convergence is about to start, if it hasn't started yet. We were talking about how we are getting to this point of excess, which is practically very important. And indeed, we think that there's going to be tailwinds. And now we are going to start with our Q&A. We really hope that we will be able to answer all of them. I think that we have an electronic system in place this year so that everybody can engage, but we will be physically here to answer all your questions. Thank you.
Buenas tardes.
Good afternoon. Well, first of all, we have had a bit of a problem with the streaming for those of you who are following along online, but we're going to start with the first question. Could you please talk about the gap, how you close the valuation gap? Could you synthesize it? Although everyone who's following along will be able to see the video later on because we will upload it. Well, yes, I forgot to say that the video was going to be available. Obviously, Min Kung's video and other videos, and I know that we go quite fast, so we will have the video available. So the valuation gap is closed with time, obviously, and trusting in the market, because it's an efficient market. It's always efficient in the long term. When there is a good opportunity, the market will benefit from it, and that's happened. It is happening, and it will happen. So things that will help for that to happen sooner than later. Well, it's what we're saying currently, the return of the investor's value, which has had headwind, a strong headwind in the last 3 years, but in general, the last 10 years, we have seen the curves, and this will change. It will change when it's time, and it seems to be changing right now. And then things happen in companies. There are mergers, there are restructurings, there are company restructuring that help for that to happen. And actually, we're seeing it in our companies right now. And we're seeing owners who are restless, who feel the uncertainty. They want to change things. Nobody likes for their values to their shares to be valued at 50% their value. Having so much money in your bank account and your business not being valued as it should. But that usually is solved, and the owners have to be patient. Some will not, because sometimes they have to pay taxes, and that is linked to the value of their companies, and they want for their shares to be less undervalued. But we don't have those cases in our portfolio. Usually they're the exceptions, not the rule. So usually we like for the shares to really reflect the value of the assets or the shares. And in all the cases, as Juan has explained for Atalaya, it's 10 times cash flow by using a price of copper for 3 when it's actually 4.5. So we're a third under the current price. If we were doing it at 4.5, it would be per 2 to 3, but it wouldn't make any sense. So it wouldn't be sustainable. So all those things are the ones that allow for the gap to be closed. The one that is most probable in the short term, well, then we will have to light a candle for the return of the value investment, because that's the one that should be more in our favor in the next few months. And it's actually important, because when it comes back with a bang, because 60% in 6 months, and historically 130% in 60 months. So it's an important reevaluation. For instance, our case in 2009, for instance, we started 2007 with a maximum, in the mid-2007 of 23.8. And that's what the FMI had. It went down to 9. And from 9, it went to 40 in 4 years. So those are the things that can happen, because when things are worth it, they're worth it. And that's what we will see. I don't know if I tried to change a bit what I said so that I didn't say exactly the same I said during the presentation. Okay, so let's start with the questions. We have gotten 350 questions, so I wanted to thank all the investors who have been sending questions. Obviously, it's impossible to answer them all, but we will try to answer as many as we can and give you as much information as we can. And for those of you who have given us your data, your details, we will try to give you an answer through our Department of Investors Relations. So first of all, with regards to commissions, congratulations. The profitability goes hand in hand with it, but I wanted to congratulate you for the effort that you have made awarding the investors who stay, because not many funds do that. Have you received any comment from any banks or other funds, positive or negative comments? And do you think that in active management, we should be aware of the fact that the fund manager skills have a price, and maybe we would have to pay for that more than you would for passive investment? I haven't gotten any comment from any fund or bank. I don't know about you who are in touch with other people. No, not really. Although, obviously, the effort that we have made to try and reduce the commission to our investors, depending on how long they've been with us, because they thank us for it. Just like this investor who has asked the question, well, the less the other funds talk to us or banks talk to us in that regard, the better. But the truth is that, well, it's actually the second part of the question. What was it? No, it was basically to whether we thought that in active management, we are really aware of the fact that even the long term is not 5 years, and the skill of a fund manager does not necessarily mean that it's profitable to pay this or that commission. What actually the difference between passive and active management? What's the exact price or the price that can be paid in any business? Well, it's actually it's a price that technically from the theory tells you that the bigger price you can ask for clients to pay until they want to live. So maybe we should have increased our commissions instead of lowering them. I don't know. It's actually a question that we can't answer. You have to choose the price you want. But the logic says that the greater the value you give, the greater the price you can be paid for it. So how much? I don't know. I don't have an answer for that. But the trend in managing is to reduce commissions because it's not easy to add much value. We don't add much value in general. So the trend is to lower commissions because you have to prove that value. So there isn't really an answer. And we each have to do whatever our conscience tells us to do and what the clients will allow, because some people ask for a 20% commission. So it's amazing. So good afternoon, everyone. With the current situation, with coronavirus, they're asking us, have you managed to travel to other countries and visit companies that are in our portfolio? Not really, no. To be honest, no. Fortunately, I actually can't say it because I should have been locked down in a country, but I escaped it. So I can't really tell you about it. It hasn't been easy to do anything because it's a lockdown and it's absurd to go there when you can actually have a conversation using Zoom or other systems. The reality is that as soon as we can, it's always nicer to be with someone face to face and have coffee and talk about things than just have a Zoom conversation. So no, we haven't been able to travel much. Okay, so you said at the beginning of the presentation that certain members of the team had to leave, and they're actually asking us what impact that has in the management team. Well, not much, really, because everyone is adding value, obviously, but when we had to make decisions, we thought that the best decision to be made as a team, as a company, was to let certain people go. And we believe that right now we have the optimum size and we can keep on working quite well. I mean, there are people who work with less, some other work with more, but we have to look for the perfect size. It's like commissions, is what we were saying previously about commissions. We are really happy with the team we have and the structure we have. Now, continuing with the coronavirus topic, they're asking us what was the main lesson learned with the pandemic with regards to investment process, and what do we think that we could have done better? What could we have done better if there is something for us to have done? For this sort of situations, there's nothing for us to do. I said it previously, when there is a meteorite, when there is a pandemic, anything that happens such as that, the only thing that we can do is to have a very robust portfolio or to not have a very fragile portfolio. But right now, we don't have much debt in our portfolio. What we have with debt are companies that have long-term contracts. They are actually a reflection of that debt. So we're in a situation where we can actually protect ourselves from almost everything. So mistakes we made before the pandemic, I don't think we made any, because we saw that our objective price for the value of the funds has actually been maintained. And then there have been some situations in companies where they have been impacted by the pandemic, but they couldn't have foreseen that. So we have made other mistakes previously. As we said, there were a couple of small companies which had too much debt, and they suffered during the pandemic. But those were minor things, really, and that's normal during a pandemic. Well, 1.5% of the portfolio suffered, but that's actually something manageable. So that can always happen in a situation such as this one, a phenomenon such as this one. And I think that really, I mean, to be quite honest, I personally think, and I think that none of us would mind recognizing mistakes, but in this case, the pandemic has been something that we were looking at. We were looking at it evolve, but at the end of the summer, I felt quite relieved knowing that when I said that there is the inexorability of increases, but I knew that we were going up because our companies had not been impacted by the pandemic. So fortunately, there weren't mistakes. I mean, we cannot call them mistakes either. Even if they were mistakes, even if we had invested in companies that were impacted by the pandemic, for instance, in Forma, we were shareholders, and then suddenly they couldn't do events. That was not a mistake. It's just it's a tragedy, but not a mistake. Okay, going back to the investment team, they are asking us if we could briefly explain how you decide how to invest in a company or not. If you could tell us what's the weight of the opinion of the different members in the team, and if there is any case that you could use as an example, something that you have done during one of your meetings. Well, the day before yesterday, Juan Huerta sent an email saying that a company that's in our portfolio that provides all services had not gotten good results. Maybe we were wrong in the thesis, and someone else gave their opinion, and I also agreed. And half an hour later, well, we have changed half of our investment. It's a small company. It only represents 1%. So half of the investment has been transferred to other companies in the same sector where we're more comfortable. So that was the last one that we talked about. 3 or 4 members of the team have talked about this company. We have made a decision, and it is a decision that we make as a group. I don't know if you remember a different case, but this is something that happened 2 days ago. That's why I'm mentioning it. I'm sorry. An investor is asking whether the managers and analysts are completely committed to Cobas, and he wanted to know if anyone has remortgaged his or her home last year to invest it in one of our funds. Well, yes, I have a mortgage in my home, so yes, I have a mortgage and I have invested it in the funds. So the concept is the same one. It doesn't matter if the mortgage was signed 5 years ago or last year. So that money I invested it in the funds. If you want to talk about your examples or your situations, but I think that all the bonuses of the whole collective have to be invested. Half of it has to be invested in the funds, and the other half is given out in cash. So at least half has to be invested in the funds. I think that all of us, right? Besides the part that we have to invest, everything that I save up is in Cobas's funds. 100% of what I save up is in our funds. Okay, so I am going to read this question. It's a long one, but I think that when we looked at the profitability and the yield, you said something about this. Despite the bad years with regards to profitability that the value investment funds are going through in general, most of them have positive yields from the beginning, but Cobas's funds are suffering important losses, such as Cobas Selección is losing 18%. What do you think is the specificity of Cobas's portfolio that has led them to these results? When do you think you will reach the revaluation potentials that you have shown? Well, we have to compare pairs with pairs. We started later, so some of the positive years that other funds enjoyed from, our competitors enjoyed from, we did not enjoy from, because we started later than they did, and that was a mistake that cost us 12-15% profitability in 2018. So due to those reasons, we have that difference. So yes. Okay. Next. You mentioned the investment mistakes. This investor says that I've always heard you say that the mistake percentage is around 12%. Don't you think that ever since this fund was created, this percentage has been surpassed? No, we did have an important mistake, but in numbers, that's not the case. We have been in this for 4 years. We started in 2019 in the company that Carlos is talking about, and historically, well, in this case, me as a responsible, because they were not working for me at the time in my previous my previous period. I think in the 15 years we had 50 mistakes, 3 per year. Serious mistakes where you lose 90-95% of the investment. So if we apply that criteria, we should have had 12 mistakes, and we didn't have them. That I remember, we had 2 mistakes in Spain, Dia and Ferreira, and and 3-4 mistakes outside of Spain. So we're talking about 6 mistakes. So 1-2 per year. So we are below my historical experience, really. So that's the reality. And I think that a mistake is losing 80% or 90% of the investment. They ask me if we have considered the option of allowing for periodical payments. I'm going to answer this one. Yes, you can do periodical payments in our pension plan, and we will also have in investment funds the possibility of doing it as well. We will announce it when it comes. There have been a number of questions that have to do with this, so I wanted the investors to know that they will be able to do these periodical investments. And another question that we have been asked is the one that has to do with the inflation. How do you think it will, how a sustained inflation of 4 or 5% will impact the markets? How would it impact our current portfolio? And what sectors do we think will better respond to these inflation levels? Well, we have a slide here that shows that the value investment historically is the one that better responds to inflation. I understand that the reason for this is that they are companies that have very low figures. So if we discount benefit to 5, 6, 7 years, then it would not really harm them in highly inflationist level. And when you're discounting, when you're talking about 25, 30 times figures, then if the inflation is very high, then your discount rates are very high, and then the returns from the last years is worthless. So some managers have calculated this, and the results are quite dramatic. If you discount to 2 to 6% for value and growth investment. Now, in the short term, as we explain it here, gold and commodities, we talk about Bitcoin as well, which replaces gold, or cryptocurrencies, which are substituting or replacing gold. They behave quite well. In the long, medium term, shares behave as well as gold and commodities do, because it's the same concept. You are the owner of assets or real estate or whatever it is. So when you own that sort of an asset, it works quite well as a defense against inflation. And since we are shareholders in value companies, we will have a better result than shareholders who have a share in growth companies. So history tells us that an additional 8% for value over growth in inflationary environments, which is enormous. So all the signs tell us that it is now our turn. We've also been asked if we think that there is a bullish situation in raw materials. What is our way of reading this? Well, we would have to study each raw material separately, because steel, for instance, is at a record level, and the oil sector is just steel as well, is at the minimum level. So we can't talk about commodities. We have to talk about steel companies or oil companies. So the offer and demand in each sector is the one that determines really whether that sector is or segment is attractive or not, and how easy it is to have new offer to satisfy the demand. So it depends on the inflation. It might also be due to the fact that instead of giving us or of getting massages or having a beer at the bar, we're now buying things, and things require more raw materials than traveling at a certain point. When that changes in 6 months' time or a year, then maybe raw materials will sink down, and everything that doesn't require so many raw materials will once again recover its value, such as traveling, for instance. That should be reasonable. And we also have to consider that there is another element, which is the inflation, because there is an excess of currency in the system. That's a reality. And it's not going to come cheap for states to be completely in debt and central bank to be to be printing paper nonstop. That is going to create inflation. I don't see a way for that not to cause an inflation. Okay, I'm going to read this question that we are being asked. Paco, during the Berkshire's meeting last Saturday, Buffett said that the easy money policies have completely changed the landscape. And his message to investors in this high uncertainty environment is that they have to invest in the long term with a very good team. Do you agree? Inflation and deflation, or in any situation, here and in China, obviously, long-term and with a good management team. Yes, obviously, you always need that. And another investor says that, asks how we see the situation if the central banks stop buying bonds, and where will all that money go with those low rates? We've already talked about that. It's getting money out of nowhere is not possible. The only way to create money is by working, by innovating, creating productivity for things to be a bit cheaper. If it costs 1% to manufacture this or that, with that 1% that we save, we could then create other things, and we could generate new things that could be found interesting. That's the only way to create wealth. Talking about a lack of demand in the economy and so on is just showing that you're an ignorant from an economical standpoint. Okay, we'll continue with Omaha. Buffett also talked about cryptocurrencies, and he said, I hate the success of Bitcoin, and I can't see how that money that is so useful for kidnappers, extortionists, and so on could be valued. Do you agree with those words? Well, actually, language is actually complicated. You could say the same thing about gold. When people who lost all of their possessions, they could really survive thanks to small amounts of gold or raw materials that they had, jewels, and so on that they possessed. So there's always good people and bad people doing things. Things are not good or bad. It's not because of the use. It's because of the use that people give of them. So bitcoins can be good, and people can use them in a wrong way. It's just like gold or anything else. I don't think that we should morally judge Bitcoin. It doesn't really make much sense. Okay, so now let's change topics and let's start reading questions about our portfolio. One of our investors said that after looking at the quarterly reports graphs, except for the Spanish portfolio, all of the other funds have the lowest objectives that they have ever had. Why have we reviewed those objectives? No, it's not the lowest. It's stable. It's not the lowest one. I mean, we showed it. We were in a similar situation at the beginning. It's actually something that we could have done today, and we didn't do it. And to be honest, we have actually told you that story. If it wasn't due to that 15% that we have lost in value due to some errors, we would be 15% above. We would be around 180, 190. We would have climbed the steps slowly, and we would be better. So this gentleman is right. We haven't climbed as much as we should, but that is the main reason. In the value creation that is generated year on year, we have actually eaten it up due mainly to that big mistake in Aritza in 2018. Okay. There was much interested with regards to Ming Kun's information regarding Asia, and there are many messages congratulating him for the information. We will send him those congratulations. And what they're asking us is, on the one hand, whether we find any important differences with regards to investing in Europe or in the US compared to Asia. And the second question is, why don't we have any Chinese companies in our portfolio? Well, we do have some Chinese companies. We have one from China, one from Hong Kong. One is China Mobile in the big companies fund, and another holding from CK Holding, actually, and which belongs to a Hong Kong family who have a Chinese passport. So it's true that China is a country where we're a bit more uncomfortable. I mean, we're scared about it because the decisions are not always financial companies. That's why we only have 1% in China Mobile, although it is quite attractive from a valuation standpoint, because in the end, the guidelines of the Chinese government are always to favor the Chinese companies. Well, it's actually a problem that we generally find in Asia. We are in family companies, but it's true that sometimes families do things that are not positive for the third-party investors. So in many cases, we could have a stronger position, but we don't have it because you are uncertain with regards to the behavior that the company will have in the midterm. Usually things turn out well, but we always have that small question mark with regards to increasing our position in those companies. And we also have a question, Juan, for the automotive sector. Does the chip crisis that is stopping the production of certain vehicles, such as Renault and Jaguar, Land Rover and Ford, have an impact on your decisions? Well, there is much uncertainty, and the companies that we talk to and that we follow closely, they don't even know what the impact will be in the short term. Short term is the next 2-3 quarters. We invest usually for the next 5 to 10 years. So that's actually short term for us. And they don't even know, the companies don't even know if the impact is going to last just a quarter or 2 quarters. And there is some consensus with regards to the fact that during the second half of this year and at the end of 2021, the situation should be solved. And the bottlenecks with regards to chip and semiconductor offer will be solved. So as an answer, I would tell you that we don't really think that it will have an impact from a structural viewpoint in our investment in companies. It should be something seasonal. So we as investors don't even know what the situation is, but the companies don't know either because they have to wait for the chip manufacturers to tell them when they will solve the problem. So there is much uncertainty, and it could be, solved during this summer or at the end of 2021, but in the end, it will not structurally have an impact on our thesis when investing in these companies. Thank you, Juan. Before we continue with the next question, I wanted to tell you that in our YouTube channel for Value School, we have published different videos with regards to chips. For those of you who want to dig deeper into that topic, they're actually pretty good videos, and I recommend them. Carmen, a question for you. How do the cell phone purchasing contracts impact Dixons? What are they doing with their cash flow? Are they going to use it to grow, to pay debt? Well, the mobile business is something that is not going to be sinking them because these contracts are reaching their maturity, and the first ones have already expired, and they have received £200 million for those contracts. And besides that, they have actually closed most of the shops they had, and they expect in spring next year to stop losing money. So although they're going to lose money from an operational standpoint, as these contracts expire, this is a business that is going to generate much cash flow. So at the end of April, they closed with 150 million cash flow, and next year they will also have net cash. And what will they do with that cash? Well, they still haven't told us. I think that the results that will be published on June 30th will give us an idea of what they're going to be doing. But I think it will be a mix of everything that this investor has asked. We, as shareholders, as important shareholders, every time we talk to them, we remind them that we would prefer for them to repurchase shares, to buy back shares, because that's what really has value for investors when the companies are not valued, are undervalued. But we will have to wait until June for an update, but I hope they will start paying out the dividend because they canceled it because of the pandemic and the doubts that they had, and because they received money from the government. They have already paid the government back, and the pandemic actually has favored them. So I think that the dividend will be established once again, and we will see what they announce for the following months or years. Thank you very much, Carmen. We have another question for you, Juan. In this case, case, we have an investor asking us about the Volkswagen presentation, Volkswagen compared to Tesla, and he's saying that although this is an attractive thesis, why is it only 1% in our international portfolio? Well, I haven't really explained it, but because I tried to explain, well, I wanted to explain, and Paco will explain it, as companies start being revalued, although they're still attractive, we will have to compare them with other investment options. And even if there is a potential for the revaluation of a company, and there is attractive in Volkswagen, there are many other companies in the portfolio that have a potential or an even greater attractive. So when a company has an 80% and we see that their revaluation process, then that money is sent to other opportunities that are more attractive. And that's really the process that we follow internally and that we have always followed. Nothing to add.
Ivan, this is a question for you. There was a quarterly comment that was released last Friday, and we've already talked about the takeover bid, and they're asking us to expand on that. As you said, we already brought it up on the quarterly newsletter, and we think that the price of the takeover bid is very low. And also in our quarterly newsletter, we mentioned that, well, in any company, there's subjective elements factored in the valuation, but in CEMAPA, if we stick exclusively to objective aspects, we see that 69%, which is held by a Navigator, minus the debt of CEMAPA's holding, the valuation is 14 euros per share. And to that, we need to add a subjective price for the Cecil portfolio that CEMAPA holds, which has yielded an operational EBITDA business, which is approximately 60 million euros. And you can add any multiple to that. We could argue that. But at the sector, it's approximately 6-7 times. And you could even say 5. And there's another subjective factor, which is the fact that I think that the objective value of Navigator is above 280 or 290. I don't know where it is right now, but it's above what the market says. So I'm practically repeating what we already mentioned in our quarterly newsletter, but there's not much more to add. There's very few investors that have done this valuation. Our valuation is above 20 euros. So at 12.17, I think there's a big difference between what has been offered and how much the company is valued. And in the quarterly newsletter, we also mentioned that it wouldn't be the first time that there are successive takeover bids. I think they will get to the 90% that they need, actually. There's many value investors at the company, and we'll watch and see what happens. But all in all, there is a clear objective value, 14 euros per share, plus other subjective values which cause the company value to be way above 20 euros. And I apologize for saying it this bluntly, but 12.17 is a ridiculous price. Vicente, about Repsol. In this case, they're asking us how we see the great investments that Repsol is making in renewables. The free cash flow relationship for shareholders could suffer the impact in the next few years. And the other question is whether we see any renewable companies which could be interesting to invest in. Well, Repsol has an ambitious plan, which is basically to invest 20 to 30% of the total capex in renewable businesses. Now, how is this financed? Through cash generation from other businesses. The upstream business will be very intensive in cash generation because actually they've reduced the investment in exploration for the next few years by 1 billion. That's how you obtain the cash to finance renewable business. And also in the industrial business, they're going to be generating a lot of cash in the next few years, and that brings in additional cash to invest in renewable businesses, which are not just about renewables, but we're also talking about low-carbon businesses, such as, for instance, biodiesel, oils, waste, hydrogen. Now, is this going to have an impact on shareholders, the free cash flow for shareholders? Well, they said that they're going to pay 0.6 euros per share in terms of dividends, so which is 6% at current prices, and the business plan, it's financed at $45 per oil barrel, being almost at 70. And anything you get from $50 per barrel, which is the base case that they have used, it's going to be used to buy back shares, their own shares, which will entail a greater remuneration for shareholders and a greater investments in this energies. Now, whether there's always the doubt as to whether if you have additional funds, you should place them on renewables, your own business. Well, we have this type of decision to be made internally, and they have to make that type of decision. And seeing the good opportunities that arise in their traditional business, we also encourage them to capture the value that still remains there for the next few years, because there's an important sum of oil there. With regards to other renewables, well, I think Ivan could elaborate on that, but in our portfolio we have Elecnor, and there we have the renewable business. We are not paying what the market is paying for renewable business, which is 15, 14 or 50 times, but actually Elecnor is giving us the renewable business at no expense practically today. And that's an example that goes to show that there's a deficit in the market and we're trying to make the best of it. Ivan, would you like to add to this? Well, at Elecnor, they're giving us the renewable business at no expense. They have 3 businesses: engineering, wind power, and transmission lines. The renewable business is at no cost because if we apply to the engineering business the multiple that we would practically have the same valuation as we have for Elecnor. And Elecnor has more than 1,000 wind power megawatts and a business for transmission lines, with their partner, it's APG, one of the most important funds in Europe. By the end of 2019, they valued it at more than 500 million. So in addition to the renewables business, we have the infrastructure business for transmission lines, and that's at no cost. That's for free. You have to find the more inexpensive way to be in the renewable business. Since Elecnor has been brought up, it's been the top one in our portfolio for a long time. They're asking us whether we no longer consider that it has the greatest potential and it's no longer in the top 10. No, this is something that we also explained in the annual newsletter. This is due to technical reasons, as you know, because this is a fund, it needs to abide by a series of regulations. The 540 rule, which is that they cannot, these companies that exceed 5%, they cannot add up to more than 40%. And when we had to do the exercise in November, we determine which one had the lesser potential in Spain. And in the Iberian Portfolio, we reduced Elecnor's weight to 4% because of technical reasons. And I'd rather not talk about potential, but it's clear that it's very close or even above the average of the Iberian Portfolio. It's not that we don't like it that much. It's actually that at that point, Atalaya had more potential than Elecnor. Thank you. Ivan, they asked us several questions with regards to Chile, whether the retirement homes have competitive advantages. And they consider that it would be relatively easier to get some real estate, and therefore the brand power shouldn't be that significant for our decision making. And they were also asking us about the financial situation, which is not optimal, the financial situation of the company, and we agree with buybacks instead of amortizing debt. Well, if you are a company delivering services to the healthcare system, you will basically need a very good track record in order to obtain your licenses. And in Italy, you know, there's a lot of red tape, and it's very cumbersome to obtain your licenses because the regional minister of health decides on granting the licenses to a company in particular. And for instance, they grant the licenses based on whether they have elderly homes on several locations. And this is an entrance barrier, actually. Cost is a leader in Italy, and they have a 3% market share. Orbea tried to get in a few years ago, and they didn't reach the market share that they have in Germany or in France. And talking about debt and cash, I don't think the approach to the question is right, because cash is held by Cheer, which is the holding, but COS has some debt, but it's really not significant. If we actually take as reference the typical debt that we've had, according to IFRS 16, they have 200 million in debt, if my recollection is right, and that's a debt that's real estate backed. And COS, therefore, has a debt, but it's asset backed. And additionally, Cheer has 350 million in cash and a market cap of 600 million. And last Friday, in the general shareholder meeting, they also approved to start the buyback program up to 20% of the stock market cap. So I don't know, if there's no other way to grow, the only way to grow is to buy back your own shares. They're asking us about the turnover of our portfolios. This investor in particular has issues understanding why the management company is not agile in changing companies, especially amongst the top positions. He considers that we sold Israel Chemicals, even though we bought it back again. But that's the market where we work. I mean, there is still potential, and it's normal to take for the market to take some time before they recognize the value. It's really not that different to what has been traditionally happening to us. And this goes back to what I mentioned earlier. It's a pity that last year our companies were really not impacted by the pandemic. 85% were not impacted, but their market price did take a hit. And this didn't allow us to make the traditional move that we would do, defensive values, which normally we have in our portfolio, and moving toward more aggressive values, which are the ones that we have to get when there's a decrease in stocks by 30%. We couldn't fully do it. We did it partially with some oil companies, G3, Israel Chemicals, and we bought back some of them, and we entered the virtuous cycle of companies that we already knew. We sold and bought back, and that's quite fine because it doesn't require any analysis, and it's comfortable and easy, and it doesn't entail a high risk. But we couldn't do what we wanted to do. I remember that in my previous stage, the 5 main values like sourcing, Thales, Voltes, etc., for 5 years, they were the top holding in our portfolio. We need to be patient so that things follow the right direction. And it's not easy to find companies that are valued twice their price. And it's not easy to say, okay, let's place 6 or 7% of the fund in this on this company and see it double the value overnight, and that doesn't happen. And we've had some headwinds in value, but when the right time comes, we'll do so. But we haven't been able to. The valuations that we were waiting for haven't arrived. So we've had some questions about Babcock. So I'm trying to summarize them all in one. Is Babcock a value trap? Secondly, it is my understanding that the company is going to sell part of its activity, and there's been a decrease in the capitalization of the market. How does this affect the intrinsic value of the company? Do you still consider that Babcock is a good investment? If it were a value trap, it wouldn't be in our portfolio. But the question is really about whether Babcock's value has decreased in this past time. Well, in order to answer the question, it's important to know what Babcock does, and as a consequence, what is it that has happened? Well, Babcock essentially supports their main customer, which is the UK government. Before Babcock, there was a company which was called Bay Systems, and there was no competition for it. It was a trust, actually. And it operated at cost plus margin. So there was a perverse incident because it was a monopoly, and the more cost that you transferred to the customer, the higher the margin you'd get. So early this century, they said, okay, let's foster the inclusion of one more company. Not that many more, because there's no room for many more, but just one extra company that will make money getting us savings. So every 100 pounds sterling that the Babcock gets, then they would save 50. And what has happened with coronavirus? Well, this happened because, as we explained last year, they were over-earning slightly because they were getting savings to the government, and they were the only one in doing so. So we thought that the British government would learn and they wouldn't maintain those very high margins. But what's happened with coronavirus is that they weren't able to work. We're talking about very staff-intensive type of work, and they couldn't work in the efficient manner that they did in years before coronavirus. So the savings that they rendered to the government were lower, and the margins that they're going to be making this year and possibly part of next year are lower. Therefore, there's been an adjustment in terms of value, in terms of the intrinsic value of Babcock and our value, and the value is still there, but it's going to take longer. So that delay in time has been adjusted through a lower valuation, and this goes to explain why the objective value of funds hasn't increased accordingly. Now, with regards to the sale of part of this company, because now there's a new management team in the company, and what we did was to talk to the executive manager when he joined in September, and basically he said, we have bought company shares. Well, he said, personally, I've bought company shares out of my own pocket, because if this is how much Babcock yields, and without asking too much from it, this is how much it saves, then it's really worth it. And his analysis was, why is it listed in the market for less than it's worth? Basically, he reached two conclusions. First, that the market was not really believing the proceeds that the company was reporting. And indeed, they did an accounting review, and they did their checks to see how much was there. And they did their review, and they have reached the conclusion that they would have a profit 30 million smaller, which is a lower percentage in terms of normalized proceeds or profit. And in addition, he said, okay, we can cut back our staff and save 40 million. So therefore, we would adjust our profit and have plus 10 million. And in that way, we would partly solve or clear the doubts that the market has with regards to Bangkok's capacity to generate normalized profit. And when the market analyzes Bangkok, they see that there's 4 business divisions, but as part of those divisions, there are many other businesses. So why don't we try and simplify this? Why don't we try and see if there's business lines where we are getting profit, but we cannot really improve them much? Why don't we sell those? Why don't we reduce our debt doing so? And part of what we obtain will be invested in parts of the business where there's room for synergies, and that would create growth. So the sale of those businesses shouldn't affect the intrinsic value, but at any rate, it does position the company better towards the next few years. Thank you, Juan. We have a more general question. They're asking whether if the companies that we're investing in have such great potential. If we're a fund which is renowned and has importance, why don't we perform as activists? Why don't we try and redirect the performance of companies as we've done with Aritza? Well, generally, we're quite happy with what the companies are doing. We're not asking them to do more than they are. And most of them are family-owned, and we really cannot do much more than supporting them. So we're not going to engage in battles where we stand no chance of winning. With regards to companies that are not family-owned, as was explained by Juan when he was talking about Dixon's, or when we were talking about Bangkok, whenever we see a situation, we talk to them and we share our opinion on things. But normally, we're talking about people in the right mind, and they do things correctly. We don't really need for what happened to Aritza to happen. What happened was that the management team did something that was completely irrational without considering the shareholders. And in general terms, we see that companies are doing things that serve the shareholders well. And whenever we see that that something happens, we take action, and we are going to continue reinforcing the competitive advantages that exist. And we need to be patient. Companies need time to do things. We really shouldn't be breathing on their neck. There are people who are quite rational. Juan, we have received many questions about Goller's investment thesis. Firstly, one investor is asking whether we think that Goller is a cyclical company or what type is it? What type of company is it? Another investor is asking about the fact that he thinks that there's an unstable management team. So isn't this a worry? Shouldn't we have a company to establish the value? And also they were asking us about valuation prices. Well, starting with the first question, is it a cyclical company? Well, no. As Paco touched on, Goller is the main competitor in floating LNG infrastructures. There's 5 in the world. One of them is not working. It was built by Shell, and it's been on standstill for 1 year, and I think it cost them $40 billion, and there are another 2 on their way. And then we have Gollers. It's been working and performing well for 3 or 4 years, and they're basically spearheading this area. Why isn't it cyclical? Well, because we have our opinion with regards to where the energy sector is going to, and we think that gas has a very important role to play. Even though there's an energy transition going towards renewable power, but you cannot take a giant leap between coal and oil to renewable energies. There needs to be a transition, and gas is a power source which is less contaminant than oil, 55% so. And also it's less pollutant than coal. And we considered that it could be the energy selected to transition towards renewable energies, which at the end of the day won't be 100% of the electric mix. We don't think it's a cyclical company. As Paco said, we think that it's a growth type of company. It's exposed to an industrial sector, which is that of natural gas, which we consider will continue to grow. And there is significant demand. It is on the rise. Actually, during COVID, liquefied natural gas imports increased in China, India too. Emerging countries actually need this energy source, and it's less contaminant than other sources of energy that we're leaving behind, such as coal. We must remember that China still has 65% of their energy coming from coal, which is the power source, the most contaminant power source that exists. So once again, we don't think it's a cyclical company. We think it's a company that will have structural growth. We're talking about structures, but there's infrastructure, but there's also another part of the business, which are ships to transport LNG, such as, for instance, TK. There could be some cyclicality in the short terms, but we need to be long term, because there will be more supply and more demand for LNG, and the LNG will have to be transported, and there could be some cyclicity in the middle of this process. Fleets have decreased due to COVID, then they increased in the first few months of 2020 because there were lack of ships. So there is some coming and going, but we think that it's not a cyclical company, and the situation is positive. With regards to the management team, it may appear that there's been a lot of replacements, but this investor is asking this. I don't know if everybody knows this. The CEO has announced that he's going to resign from the company. He is in a transition period, looking for a candidate. This person had been in this position for 4 years, and it's a company, Goller is a company that has a very entrepreneurial spirit. It's very dynamic, and the founder of the company, Torolaf Troy, the main shareholder, he's a Norwegian man who is very involved in the business. He's very invested, and we like this. We really like that the reference investor is really involved in the business, and that his interests are aligned with ours, and this actually generates value in the long run. And this person is very involved, and we don't really know the nitty-gritty of what's happened or why the CEO is resigning. We don't think it's something cumbersome, and they're looking for a replacement already, and it doesn't seem that, taking into account the structure of the company, it doesn't seem that this person had really that much of a key role. The owner is one of the main persons, and actually the CFO is someone with whom we have a direct relationship, and he is very valid. And the last question, what was it about? New Fortress. Well, it's actually a good question, because based on what's happened with the sale of the downstream business, that is natural gas, electric generation. Well, we actually explained this in our quarterly newsletter. They have sold part of the company to New Fortress, U.S. competitor. They have $9 million in capitalization, and they have received cash and shares. And what's the reason for this? We wanted to continue to be involved in power generation, and we need to actually value how much the shares of New Fortress are really worth. And we have a price which is above the current listed price of the company. There isn't great potential there, but we think that the operation has been performed under reasonable terms and currently New Fortress has a price below what it should be. And actually, there's great growth ahead for this company, and we're not really factoring it in our valuation, but it's a growth type of company. And if they actually meet the objectives that they have established, and they're doing so currently because they have a very powerful CEO, I think they should do more even. I don't think I left anything unmentioned. They are asking us about TK. In particular, this investor would like to know whether we see more revaluation potential for TK Core, and they're asking us about whether the renewal of Hammerberg's contract could be a trigger for the revaluation. What contract? Hammer. Wow, great detail.
We have more shares in TGP because we couldn't really do any differently. We have 14% of the company, almost 15. So obviously this gentleman is absolutely right, and we see more potential in Tiki Corp, which is a subsidiary, but we have shares in both. But we're actually purchasing the same thing because the mother company, its main value, 80% of its value is the subsidiary. So it's the same cash flow, either upstream or downstream. So the valuation is 4%, I believe, Hamok. So whatever happens with Hammenberg is not essential in our investment thesis for Tiki Group. Okay, so we're being asked, well, Vicente, they're asking us about the pharma sector. Could we talk about the impact that the pandemic has had in this sector, especially those companies that are in our portfolio, such as Teva, Patrick's, and so on? Well, in the pharma sector, the impact that we have seen in our companies is a minor impact. The over-the-counter companies that we have not been impacted. We've also been doing in the pharma sector the following. We have benefited from the fact that some companies have been impacted negatively, such as Grifols and Fresenius. We purchased them for our big companies fund and for the Iberia fund that's with regards to Grifols. These are very interesting companies that we have been following up closely for some time, but we like them, but they were too expensive. But with the pandemic, we have had negative news, and Fresenius is a holding that does dialysis, and they have been impacted negatively. The visits to their dialysis clinics due to COVID, and because there were less patients, so they were impacted at the beginning of the year, and we had the opportunity of purchasing a very good company with good business the world over, and with entrance barriers at a reasonable multiple. So we purchased it at a very good price. They are world leaders in dialysis. It's a small oligopoly, and they have a percentage of the company called Fresenius Medical Care. The other part of the business is Calle, which is a business for IV drugs, for hospital nutrition, which is a very good business as well. And then they have another business, which is, for instance, hospitals such as Quirón here in Spain. They have very good hospitals, quality hospitals, and due to the pandemic and the temporary problems that they had, that gave us the opportunity of purchasing this high-quality company at reasonable numbers. And with Grifols, it was the same situation. It's a quality company that we always liked, but we couldn't purchase it because they had very, very high prices. But thanks to the pandemic, what happened was that the plasma collection that they do to produce plasmatic proteins to treat some chronic diseases was reduced, and that obviously had an impact on their results lately. But this is a company that once COVID is over will no longer face that problem and will overcome it. So it's a company that was an oligopoly as well. There were only 3 players in that sector, and they have 60-70% of the market amongst the 3 of them. This is a company that's growing. It's 5-6% income. They have very good profitability. They have a bit more debt than we would like because they had been doing some acquisitions, and that is why we have a small part of the company, but a reasonable part. So what we have done with COVID with regards to the pharma sector is benefit from the situation to purchase some companies that have been negatively impacted, but that are companies of high quality that we couldn't have purchased previously. Paco, you were talking previously about growth and value. And we're being asked if there aren't companies called growth companies, or the ones that are considered growth companies, such as Tesla, Amazon, and so on, that could be in your radar for future investments. Have we ever studied them? It's not our knowledge area. Would we rather invest in what we know? And lastly, we are being asked if we don't think that the market is sufficiently studied to be missing out on jewels below Pair 12. Well, we don't have the money to invest in Pair 12 companies. We have had to sell an important part of our post because it only has 50% potential. So it's an amazing company that we really like because we needed money to invest in companies that are worth 120, 130%. So it's not about not lacking companies where we could invest. Clearly, that's not the problem. We have been, whether we have looked at Amazon and so on, no, we haven't looked at companies such as those. I have never invested in a company that initially it's a company where we have to pay over 12 or 13 times benefit. I'm sorry, but I cannot do it. I need a greater safety margin. And businesses where those companies are present, have we invested there? Yes, we have talked about Dixon's. We have talked about, I don't know, for instance, this Vocento, for instance, where we have an important position. It is the second business in Spain with real estate and automotive. So that business is being paid at 25, 30% benefit. And so I know you know what prices have been paid for Dinerista, and that's within Vocento, and it's for free, obviously, which is what we like. We've talked about Elecnor and the renewable energy business that came for free in Elecnor. We love those businesses, obviously, but a reasonable price. And if it can come for free, then that's even better. On the other hand, we don't like businesses that are novelties, very new things such as Facebook and so on, which are beginning, which we don't really know where they're going to, how they're going to develop. I asked my children, I have 5 children, 8 from 18 to 9 years of age. They're always on their cell phones. I mean, obviously, limited time so that they don't have their brain fall asleep, but they spend as much time as they can on their cell phones. And none of them is interested for Facebook. None of them want an account on Facebook. And I ask, and your friends? No, none of them have Facebook. No one's on Facebook. No one is interested in Facebook. That's for old people. It's an awful page. So if someone were to tell us, no, I'm not interested in cars. Nobody wants a car. Obviously, my 18-year-old is just looking forward to getting his driver's license and driving a car. If someone were to tell me that none of their children or their friends wants to drive a car, then I would really think through my automotive business investment. But so I think that Facebook is one of those businesses that are risk capital. I don't know if in 10 years we will still use Facebook or we will stop using Facebook. If it still continues at this pace when young people are not interested in it, then they have a serious problem. And obviously they have WhatsApp and they have Instagram. When they start getting paid for WhatsApp, then maybe, I don't know. But in any case, we are paying 30 times for that? No, we follow it up because we are interested. Obviously, we are clients of Amazon. We use Amazon and Azure from Microsoft. And the other day, I was asking my IT guy, what if we leave Amazon? And he said, well, if O1 offers me 25% less, then maybe, because their operative margin, I'm not really sure, but it's around 25, 30%. So if Google offers 25% less in the cloud, because that's where Amazon makes its money. They don't make money with books. They make money with their cloud business. Would we leave Amazon? Yes, obviously we would migrate. We wouldn't have any problem. So they have businesses that, well, we don't know where they will be in 10 years' time. We were talking about the Babcock and the value trap. What do we look for in those businesses? We want an entrance barrier. We want it for it to be unique and difficult to copy. Obviously, the British government is not going to allow Chinese to maintain their nuclear stations. And then there needs to be some sort of visibility for the next 10, 15 years and some safety. That's what we're talking about. The homes for the elderly or knee surgery, what cost does. Buying electronic and appliances, that's what Dixon's does. Natural gas, that's what we talked about. Things where we do have a clear visibility. And if we're paying 6 to 7 times, well, I think that's perfect. That's what we should do, clearly. So that's why we're not investing. I mean, yes, we're interested in following up on Facebook and so on, but when it's 30, 35 times benefit, when they're worth 2,000, 3,000 million years, I mean, 2 to 3 trillion, that's too much. And people ask us about Amazon, Facebook, Apple, and so on, but nobody asks us about Yahoo or American Online or eBay. Why don't you ask us about those? They were fashionable 15 years ago, and they've all disappeared. In 15 years, will Amazon still exist? Well, Amazon will exist, at least with everything that has to do with retail. Will they have the same competitive position in the cloud business, or a business that is only 8, 9 years old? Who knows if they will be there? Well, we have a few questions that have been asked about Aritza. This investor would like to know what our current opinion is about the company, how we assess the sale in the U.S., what is our perspective with regards to the company, and what its potential, and if we could recover that investment. Well, let me try and explain that. Vicente, maybe you could explain that. Aritza is just one of the companies we have in our portfolio, just one amongst many. We had a very important participation, almost a very strong position, almost 15%. Now we're below 10%, clearly below 10%. It represents 5% of our international fund. It's just one of many where we make decisions, sell and purchase decisions that we have done, especially selling in the last 2 years at the right times. But as we would have with any other company in the portfolio, no more than that. And maybe you could give Vicente more details about how we do it right now. Well, with regards to the perspectives, well, basically in the last few months, we have seen important changes come about in 3 fields, I'd say, that allow us to be much more optimistic with regards to the company. On the one hand, we have seen a change that was proposed by the shareholders, and we supported, obviously, the shareholders in the board of directors and the management team. We wanted to reinforce the management team with people who have an experience in the industry. For instance, the CEO and the current president, Urs Jordi, was the old CEO for Aritza Europe and Aritza Asia, which is what we currently have in the company after the disinvestment that we did in the U.S. So we have brought the best management team that we could bring, who know the company, know the sector, know the suppliers, know the clients, and so on, so that they can lead the company along the right path. And we have reinforced the board of directors as well. Now we have various experts around the table who clearly know the industry and who are providing a very positive support to the company so that they can continue with the decision-making process. So not only have we reinforced the management team, we've also sold, as you said, the U.S. business. And this allows us to reduce problems. So we previously had lots of problems. We had a big debt. Now we have solved the debt problem. And now we have our management team focusing on managing the business, which is what they know how to do because they're experts in this sector. And thirdly, we have an operational efficiency plan. We have an objective for the next 12 months. So when their year closes in July, they will be in EBITDA margins of around 12.5%, which is the average in the industry. And everything that we're seeing are we consider correct decisions with a management team who knows the industry, taking the right decisions aligned with the shareholders. And if you ask about my opinion about what we should have done, well, the perspectives have actually improved, and now the company is following the right path. This is the right trend, so that we can recover part of the investment. Okay, so telco sector. Carmen, maybe you could answer this question. They're telling us that operations are being made where we're paying 7-8 times EBITDA, and the purchasing company has usually a ratio of debt to EBITDA over 6 times. Do you think that is reasonable while the traditional operators have lower ratios? Do you have that sort of a company in your portfolio? Well, I should maybe start with the final part of the question. In our international portfolio, we don't have anything from the sector. In the Iberian fund, we do have a 1% of SANTACOMBA, which is the holding where Sonoaes has its participation in us, which is the number 2 of Portuguese telcos. And then we also have a KT Corp, which is the incumbent in Korea. This is like Telefonica in Korea. Then we have China Mobile, as Paco was saying previously, and we also have CK Hutchinson, which is a group of companies and businesses, and one of them is telco in the UK and Italy. And the first part of the question, I think that without giving names, I think that the investor is asking about the MásMóvil Euskaltel transaction, and I think that we don't have shares at Euskaltel, so we don't really have a defined position or opinion. It's true that the resulting company will have a very high debt, but after the takeover bid. But I think that that is a question for the rating agencies, not so much for us. Well, thank you. We have a few questions that have to do with our investment philosophy. For instance, this person is asking us about what we prefer. Would we rather have a PR8 company that has a 3% growth rate, or a PER16 that has a 16% growth rate? No, I'd rather have the PER8 because we never value the growth. We always have in our models a growth of 2-3% around that. We never valued anything else because growth is always attracting capital. And when in a business you grow a lot, there will be lots of capital, and after 4 or 5 years, we will have a hard time in that business. So systematically, having a high growth rate is very, very dangerous. And if you're paying 16 times instead of 8, no doubt whatsoever, I would choose the first one. How do we value the intangibles? Well, we have to consider the capacity of generating free cash flow in the business. That's how you assess them. In the end, intangibles, well, they have a right valuation or wrong one. After 3 years, maybe the valuation wasn't correct, and what shows the value of the intangibles, as in Coca-Cola, is the return on capital and the cash flow generation capacity. So that's how we assess it. When we think that the business has strong entrance barriers, then maybe we could apply a 17 times, 18 times multiple. If not, then we would use normal multiples, 14, 15 times, which is the mean, the market's average. And that's how we consider the value of those intangibles, which actually are simply barriers, access barriers or entrance barriers. Do we think that our fund style is compatible with companies of quality, even though they might have high multiples, such as, for instance, Fund Smith from Terry Smith? We always want more in life, but their ROCE would be 30%. And I would like to know what the ROCE is for these companies that they were mentioning. This person was mentioning, and Terry Smith's fund, which I don't know. But comparing companies that have a 30% ROCE, so the return on capital that we use, we invest 100 in a business, and the next day it's generating 30. Those are exceptional businesses. with the average that we have, and they're already established. It's not even a new business. Maybe they generate 30 one year, and then you don't know what will happen in the next 5. So doing it better than that, I think it's complicated. What would it be? 40. We want companies that can improve the fund, but it's difficult to improve our fund, really. So this is a very long question. I'm going to try and summarize it. You talked previously when we asked you about the profitability of Cobas compared to other funds, other managers, and they're asking us, on the one hand, what's the opportunity cost of having been investing in Cobas instead of other funds in Spain, and how can we close that differential gap between the profitability or the yield of one and the yield of others? Well, obviously, if you had another some money invested in other funds and you have had better results, then great, they did it very well. How are we going to close the gap? Well, I don't know. Maybe other funds have advanced more in the upward trend and we were delayed, but in the end, our valuation is the one that we have. I mean, we could make mistakes marginally. Maybe a company is 10, 15% less, or another one might be valued 10, 15% more, but we will have the value we have, and we have 200, 190 in Iberia. That's what we have. I don't know if the next 30 months we will have a reevaluation. I don't know. Maybe it takes us a year, or maybe in the next 3 months we can get back to what we were expecting. Maybe there are a list of operations that show the value quickly. But the thing is that we're going to go through 160. I don't know if the next month or in 2-3 years' time. And compared to others, well, I don't know. But to be honest, sometimes you look at some portfolio or other, and the values that we have in our portfolio we really like. And I personally, when I look at other portfolios, it's not that I find them pitiful. No, it's a pity that they don't have much value. They say, no, this is an amazing company. Well, yes, our companies grow in a significant way, as we have shown. These 3 main positions, not any, the 3 main positions, and the pace that they have followed, the growth pace that they have followed, that they will maintain probably. And I don't see reasons why we will not reach those valuations as well. So I don't know who will reach that point first, because this is not an F1 race. Okay, so let's finish with the questions. These are the last questions. This one this is a young investor, 21-year-old, who said that he has just turned 21, and he's congratulating us for the job done, and he is recommending us. No, I'm sorry, he's asking us, what do you recommend to that youth that doesn't have much hopes in the financial field and also in the non-financial field? So what do you recommend? Well, little hope. Why? I mean, if you're 21, you have lots of future ahead of you, much more than we do, not just because of your age, but because you are born in an amazing moment in history, because the conditions you're living in are much better than those that we were living in 30, 40, 50 years ago. So lots of hope. And if you love the world of investment, then start investing. We have looked at companies, so you can copy our ideas and you can start learning. Well, and how do you learn? By following, and you will make mistakes, obviously, as we all have made mistakes, and use our mistakes to try and make better decisions. That is what I would recommend to someone who wants to invest. Start doing it now. And actually, you don't need to invest big amounts. You don't. You simply need to invest something symbolic so that you can get the confidence you need to understand that you know how to do it. They're telling us, I invested at 107 euros in 2017. In April 2020, when we were below 42 euros, I could invest more, but at least I didn't withdraw my money. Now I'm close to 84 euros per share. And my questions are twofold. The market has been testing me, and if that is the case, have I overcome that test? Yes, obviously, you passed the test. Yes, if you're still an investor after losing 50%, of course you have passed the test. When we started in Cobas, we had a clear idea, which was the fact that the investor needed to answer the question, how do you feel with 50% less capital? And if you're not capable of answering to that question, then you shouldn't invest. You shouldn't invest in our funds. So most of the clients have actually withheld. I mean, they have stayed and they have passed the test, and this gentleman has passed the test as well. Okay, thank you. And before we ask the last question, it has It has been 15 minutes more than we said at the beginning. On the one hand, we wanted to apologize for the problem during streaming, and as soon as we can upload the video, we will do so, and we will inform all the investors that the video is available. And on the other hand, those of you who are here, I would like to tell you that when you leave, we would ask you to follow an order and respect the distances, safety distances. Okay, Rocío? Yes, I'm going to read. Paco, you have been successful as an investor. My question is, are you still willing and are you still motivated to get the best yields after so many years of success? Or could we say right now that that initial motivation has decreased because as an investor you have already shown your value? I'm going to add another similar question. Since 2011, he has been investing with you, and he imagines that the last 3 years have not been easy for you. And in that sense, this person says that his main or her main fear during these 3 years and the complaints of the investors might have had a bad impact on your motivation. So he wants to know, how's your motivation? And he asks, are you optimistic with regards to what the future is preparing for us? And another investor says, considering the experience that you have in the markets, because you've lived all sorts of situations, how do you see now that time has passed, how do you think that these 5 years of Cobas have been? So could you tell us whether this value investment style might require some changes in your way of working or considering? I mean, have you changed a bit in your philosophy after looking back this 5 years? Well, motivation is high. I cannot finish this meeting saying, no, my motivation is quite low. No, obviously, I'm looking forward to work. It's obvious. I can't even think about doing anything else in my life. So there aren't many holidays. You can't really unplug. You're always connected. And it's Friday. It's Friday, Saturday, and Sunday during the Holy Week, during Easter, because the markets are closed. So you can't really do much. You can only read. But those are a few days rest that I have, which is actually quite good. No, but to be honest, my motivation is quite high. I love what I do. And as I was saying, and as Kim Rogers said when I met him, was I love reading the newspaper, and they pay me to read the newspaper. Well, that's what we do. That's what happens to us. We read, we take a look at what's happening in the world, what businesses are doing well, when there are business opportunities. There are always opportunities, always interesting opportunities. There is always something to read about how the world is faring. So everything fits quite well. So it's quite varied. So there are no doubts. As for our management style, has it changed? No, it hasn't changed. We can always tell the same story. I know that now some companies seem to be following a different path, but it's always the same thing. American Online, Yahoo, eBay, Cisco are now Facebook, Amazon, and so on. And in 20 years, it will be 4 or 5 different companies, and we will be telling everyone with our cane that the value doesn't change. So purchasing cheap. Let me see. So we have given you 3 examples, right? So homes for the elderly. A European leader is being paid 30 times EBITDA. That is how we have to value our companies. Dixon's, it has the best value in the U.S. We have best value in the U.S. that is 15, 16 times benefit, and Dixon's that does the same thing. It's only 7 times profit. So the gas infrastructures, we have, I don't know, other companies 6, 7 times EBITDA, and Brookfield is 12, 13 times EBITDA. So these are businesses that are well valued by the market. We're not buying companies in the shadows of a market that nobody wants. Yes, nobody wants them, but they're extraordinary businesses that are well valued. That's our job, to find those good businesses, well valued by the market, but in corners that people are not looking into. That's what we buy. That's the work, and that's very interesting, and it's always going to be the same. Finding good businesses at good prices, and that's it. Okay, well, thank you all so much for being here, and those of you who are following us online, thank you so much. We always say that we hope to bring good news next year. I have the feeling that at least this year it will be the case because of what we're seeing in our company. So thank you all very much, and hope to see you next year. Thank you very much.